For decades, Bangladesh's microfinance sector was shaped by trust-based lending, best symbolized by Grameen Bank. It worked well, but as the sector grew bigger and riskier, trust alone was no longer enough. To formalize and regulate the sector, the government introduced the draft Microcredit Bank Ordinance 2025. This is Tamina Jahan, an analyst at Lion City Advisory. The purpose is simple: to formalize microfinance by creating a microcredit bank framework with clear licensing, governance, supervision, and risk controls, replacing reliance on informal practices. These banks will be supervised by Bangladesh Bank, bringing microcredit closer to mainstream banking discipline. Besides, a microcredit bank must maintain a minimum paid-up capital of 300 crore taka, providing a buffer against loan losses and protecting depositors. Share face value is fixed at 100 taka with at least 60% contributed by sponsor shareholders. Ownership concentration is capped and the bank cannot be publicly listed. And statutory reserves, audits, board structure, and reporting are legally mandated, aligning the sector with commercial banking standards. To mitigate risk, microcredit banks can now take pledge, which means keeping movable assets as security, hypothecation, a claim over movable assets without holding them, and assignment, the transfer of future income rights such as receivables. These reduce default risk, something informal microfinance struggled with. No microcredit bank can operate without a Bangladesh bank license, placing the sector under central bank control for the first time. These banks may accept deposits under Prudential rules and can enforce loan recovery through the Public Demands Recovery Act 1913, while regulators retain powers to inspect, intervene, or wind up institutions if needed. Unlike traditional MFIs that operate as NGOs and reinvest surpluses, the draft Microcredit Bank Ordinance shifts microfinance toward regulated, profit-permitted banking under Bangladesh Bank supervision by allowing profit through lending and deposit mobilization. With enforcing reserves, audits, and oversight, it could attract greater foreign direct investments and commercial capital than regular MFIs, which have limited profit channels. At the same time, while the model addresses MFI weaknesses such as weak capital, informal governance, and unenforceable recovery, MFI leaders warn that unclear conversion rules for them in the draft ordinance and profit incentives may create governance risks and dilute the sector's long-standing development mission. Moreover, while microcredit banks may overlap with digital banks in delivering small loans and collecting repayments, they serve a distinct purpose: managing ultra-small informal borrowers who need intensive screening, close monitoring, flexible repayment, and non-traditional collateral, needs that digital banks cannot sustainably meet at scale. In short, the ordinance shifts microfinance from relationship-based lending to risk-managed banking. This protects depositors, improves transparency, and makes the sector safer for long-term growth, especially as loan sizes and borrower complexity increase. At Lion City Advisory, we help institutions interpret the ordinance, design compliance roadmaps, build credit risk frameworks, and model sustainability, so microcredit banks can grow responsibly under the new rules. That's all for today. Thank you for being with us.